Did you know Warren Buffett earned over 99% of his wealth after his 50th birthday? That's the power of patience, compounding, and smart investing. Imagine if you could apply his principles to your own financial journey. How much could you achieve? Warren Buffett, the Oracle of Omaha, is one of the most successful investors of all time. He transformed $6,000 as a teenager into a fortune of over $100 billion. His strategies aren't about chasing trends or making risky bets. They're rooted in timeless principles that anyone can follow. In this video, we'll explore the 30 key lessons from Buffett's life that can transform how you think about money and investing. Building wealth feels out of reach for many people. From living paycheck to falling into debt traps, the financial journey is often riddled with poor decisions and missed opportunities. Most people don't invest because they think it's too risky or they don't have enough money to start. But Warren Buffett's approach proves that with the right mindset and strategies, anyone can build long-term wealth, even starting with very little. 1. Start early. Warren Buffett bought his first stock at age 11, but he often says he wished he had started even earlier. The key to building wealth is giving your money time to grow thanks to compounding. Compounding works by earning returns on your initial investment and the returns you've already gained, like a snowball rolling downhill. Imagine you invest $1,000 at age 20 with an 8% return. By 60, it becomes $21,700. But if you start at 30, it's only $10,900, half as much. Starting early doesn't require large amounts of money. Even small, consistent investments grow substantially over time. Buffett's wealth is proof of this principle, as much of his fortune came from years of compounding. 2. Patience is a superpower. Buffett says, "The stock market is a device for transferring money from the impatient to the patient." Patience isn't just about waiting. It's about resisting emotional decisions during market fluctuations. When people panic and sell during downturns, Buffett holds on to his investments or even buys more. Over decades, this approach has paid off. Buffett's investment in Coca-Cola in 1988 grew from $1 billion to over $24 billion by 2022. Imagine if he'd sold during a dip. Patience allows you to ride out temporary losses and benefit from long-term growth. Like a farmer waiting for crops to mature, investors must let their investments grow uninterrupted. 3. Reinvest your profits. Early in his career, Buffett didn't spend his earnings. Instead, he reinvested them to grow his portfolio. This approach allowed his wealth to compound over time. Reinvesting dividends or profits means you earn interest not just on your initial investment but on your returns as well. If you earn $100 in dividends and reinvest it at an 8% annual return, in 10 years that $100 becomes $215. Spending it means losing out on this growth. Buffett's habit of reinvesting rather than cashing out dividends has turned small returns into massive wealth. 4. Focus on value, not price. Buffett learned value investing from his mentor Benjamin Graham. The principle is simple: buy stocks at a discount to their intrinsic value. This means looking beyond the price tag and understanding what a company is truly worth. During the 2008 financial crisis, many investors avoided banks. Buffett invested in Goldman Sachs because he saw its long-term potential. Buying undervalued companies during tough times can yield incredible returns. Focus on quality, not bargains. 5. Buy and hold. Buffett famously says, "Our favorite holding period is forever." His strategy is to buy great companies and hold them through good times and bad. This approach avoids the stress and costs of frequent trading. Buffett has held stocks like American Express and Coca-Cola for decades, enjoying steady returns. The key is finding companies with strong fundamentals and letting time work its magic. Selling too early can mean missing out on long-term growth. 6. Learn from mistakes. Even Buffett makes mistakes. One of his most famous errors was buying Dexter Shoe Company, which cost Berkshire Hathaway billions. Instead of hiding the mistake, Buffett uses it as a teaching moment. Bought a stock that flopped? Analyze why. Was the company overvalued? Did you misunderstand the market? Learning from mistakes helps refine your strategy and avoid repeating errors. Buffett reminds us that mistakes are part of the journey. 7. Stay within your circle of competence. Buffett advises, know what you understand and stick to it. For years, he avoided tech stocks because he didn't grasp their business models. He only invested in Apple when he understood its value proposition. If you know the retail industry well, focus there. Don't dive into biotech or crypto if you don't understand the risks and rewards. Staying in your comfort zone reduces costly mistakes and increases confidence. 8. Invest in yourself. Buffett believes the best investment you can make is in your own knowledge and skills. Early in his career, he took a public speaking course to overcome his fear, which helped him immensely. Enroll in courses, read books, or develop new skills. Learning about personal finance or improving communication can pay off exponentially. Buffett's advice applies to everyone. Your earning potential grows when you improve yourself. 9. The power of brand. Buffett loves companies with strong brands because they create customer loyalty. Coca-Cola, one of his largest investments, is a perfect example. A strong brand is hard to replicate, giving companies a competitive edge. Think about why you'd choose Nike over a generic sneaker. Buffett invests in companies with recognizable names and loyal customers, ensuring long-term growth. 10. Avoid debt. Buffett avoids personal debt and advises others to do the same, especially high-interest credit card debt. He believes debt is a major obstacle to wealth building. Carrying $10,000 in credit card debt at 18% interest means paying $1,800 annually in interest alone. Instead, focus on paying off debt and using cash for expenses. Living debt-free creates financial freedom. 11th, embrace simplicity. Buffett believes in keeping investments simple. He recommends index funds for most people because they're low cost and provide steady, diversified growth. Instead of trying to beat the market, invest in an S&P 500 index fund. Over time, it outperforms most actively managed funds. Simplicity reduces stress and increases results. 12th, be contrarian. Be fearful when others are greedy and greedy when others are fearful, Buffett advises. When markets crash, most people panic and sell. Buffett buys. During the 2020 pandemic, stocks plummeted. Those who bought tech and healthcare stocks during the crash saw significant gains as the market recovered. Think of downturns as opportunities. 13. Diversify wisely. Buffett doesn't believe in over-diversifying. He focuses on a few great companies, allowing him to research them thoroughly and make informed decisions. Instead of owning 50 stocks, focus on 10 to 15 strong companies. This lets you allocate resources effectively and understand your investments deeply. 14. Live below your means. Despite his wealth, Buffett lives modestly in the same house he bought in 1958. His frugal lifestyle shows that wealth isn't about flashy spending. Avoid upgrading your lifestyle every time your income increases. Save or invest the difference. This approach accelerates wealth accumulation. 15. Master the art of reading. Buffett spends up to 80% of his day reading, from newspapers to financial reports. He believes knowledge compounds like money. Start with books like The Intelligent Investor. Knowledge allows you to make informed decisions, reducing the risk of costly mistakes. 16. Know when to sell. Buffett rarely sells, but when he does, It's because the company's fundamentals have changed or better opportunities have arisen. Selling isn't about chasing profits, but about strategic reallocation of resources. For instance, Buffett sold airline stocks in 2020 during the pandemic because he believed the long-term prospects of the industry had been permanently altered. Imagine owning stock in a company that consistently misses earnings expectations or faces management scandals. Selling allows you to reinvest in more reliable opportunities. Buffett teaches that selling isn't about timing the market. It's about recognizing when a company no longer aligns with your investment goals. 17. Look for competitive moats. Buffett loves companies with moats, meaning strong competitive advantages that protect them from rivals. These advantages could be brand loyalty, cost leadership, or proprietary technology. Companies like Coca-Cola, brand loyalty, and Google, search dominance, have moats that make them resilient against competition. When choosing investments, ask, what makes this company unique and difficult to compete with? A strong moat ensures long-term profitability. Companies with weak or no moats often struggle during economic downturns or when competitors enter the market. 18. Stay disciplined. Discipline is the cornerstone of Buffett's strategy. He sticks to his principles and avoids chasing trends, even when they're tempting. For example, Buffett famously avoided the dot-com boom in the late 1990s, which saved him from significant losses when the bubble burst. Suppose you see a stock soaring in value due to hype. Instead of jumping in, ask whether it aligns with your strategy. Discipline means saying no to distractions and focusing on long-term goals. Buffett shows that sticking to what works often outperforms chasing what's popular. 19. Invest for the long haul. Buffett believes in thinking decades ahead, not months. His investment philosophy is to treat stocks as if the market will close for 10 years. This mindset helps him avoid emotional decisions and focus on the intrinsic value of his investments. Buffett bought Apple in 2016 and continues to hold it as one of his largest investments. Think of investing like planting a tree. It may not bear fruit immediately, but with time and care, it can provide immense rewards. Long-term thinking minimizes the stress of daily market fluctuations. 20. Pay attention to management. Buffett invests in companies led by ethical, competent, and visionary management teams. Strong leadership can make or break a company, no matter how good its products or services are. Buffett admires leaders like Tim Cook of Apple, who align with shareholder interests and consistently deliver results. Research a company's management before investing. Look for transparency, a clear vision, and a track record of success. Strong management often signals a stable and growing company, while poor leadership can lead to turmoil and losses. 21. Control your emotions. Buffett says, the most important quality for an investor is temperament, not intellect. Emotional investing, driven by fear or greed, often leads to poor decisions. For instance, during market crashes, many panic sell, locking in losses, while Buffett buys at a discount. If your portfolio drops in value, take a step back and assess the situation rationally. Are the fundamentals of your investments still strong? Controlling your emotions helps you stay focused on long-term goals instead of reacting to short-term volatility. 22nd. Stick to fundamentals. Buffett avoids speculative stocks and focuses on companies with proven earnings, solid cash flow, and long-term growth potential. He doesn't care about hype or trends. He cares about data. Before investing in a stock, analyze its financial health. Look at revenue, profit margins, and debt levels. Companies with strong fundamentals are more likely to weather economic downturns and deliver consistent returns. Buffett shows that solid data always beats speculation. 23. Have an emergency fund. Buffett always keeps cash reserves, calling it the ultimate sleep-well-at-night fund. Cash not only provides a safety net during tough times, but also gives you the flexibility to seize opportunities during market downturns. Save 3 to 6 months of living expenses in a high-yield savings account. This protects you from financial emergencies, like job loss or unexpected expenses. Buffett's cash reserves also allow him to invest in undervalued assets when others are forced to sell. 24. Know your limits. Buffett is humble enough to admit what he doesn't know. He avoided tech stocks for years because he didn't understand their business models. Only when he became comfortable with Apple's ecosystem did he make it a core holding. If someone suggests investing in cryptocurrency but you don't understand it, it's okay to say no. Focus on what you know and gradually expand your knowledge. Buffett's success shows that self-awareness is more valuable than chasing trends you don't understand. 25. Focus on outcomes, not activity. Buffett doesn't believe in overtrading or constantly making moves. He says you don't have to swing at every pitch. Sometimes the best action is no action at all. If the market is volatile, resist the urge to sell or buy impulsively. Focus on your long-term strategy. Buffett's philosophy reminds us that wealth is built through consistency, not constant activity. 26. Understand compounding. Buffett's fortune grew largely because of compounding. He reinvests profits, allowing his investments to grow exponentially over time. Compounding is often called the eighth wonder of the world because of its transformative power. Investing $5,000 annually in a portfolio with an 8% return grows to $1 million in 40 years. The earlier and more consistently you invest, the greater the compounding effect. Buffett's entire career is a testament to this principle. 27. Avoid speculation. Buffett steers clear of speculative investments that rely on hype rather than fundamentals. He famously avoided the dot-com bubble and Bitcoin because he believed they lacked long-term value. Investing in meme stocks or cryptocurrencies without understanding them is like gambling. It may pay off once but can easily lead to losses. Buffett's approach shows that solid, data-driven decisions outperform speculative gambles in the long run. 28. Give generously. Buffett pledged to donate 99% of his wealth to charity, believing that wealth comes with responsibility. He's a leading example of how financial success can be used to create positive change in the world. Even if you're not a billionaire, giving back, whether it's 5% of your income or volunteering your time, creates a sense of purpose. Buffett's philosophy is that wealth isn't just for accumulation, but for making a difference. 29th, adapt to change. Buffett emphasizes the importance of adapting to change in an evolving market. While he initially avoided tech stocks, he later embraced Apple because he saw how its ecosystem created value. Adapting doesn't mean abandoning principles. It means being open to new opportunities that align with them. If new industries emerge, like renewable energy or artificial intelligence, learn about them and assess their potential. Just because you've avoided certain sectors in the past doesn't mean they won't fit into your portfolio in the future. Buffett's shift toward tech investments shows that even seasoned investors must evolve with the times. 30. Think long-term. Buffett's entire career is built on long-term thinking. He doesn't worry about short-term market fluctuations. He focuses on where his investments will be decades from now. If you're saving for retirement, don't let a single bad year derail your plan. Stick to your strategy and trust that time is on your side. Buffett shows that wealth isn't built overnight but through patience and consistency. If there's one lesson that defines Warren Buffett's success, it's this: focus on what you can control and let time do the heavy lifting. You don't need to predict the market or chase trends. All you need is discipline, patience, and a plan. So, what can we take away from Warren Buffett's life? Start early and stay patient. Focus on value and quality. Reinvest your profits and avoid debt. Master your emotions and invest for the long term. Build a strategy that aligns with your knowledge and values. Each of these lessons is a piece of the puzzle that helped Warren Buffett become one of the world's richest and most respected investors. Which lesson resonates most with you? Let us know in the comments. Don't forget to like, subscribe, and hit the bell icon to join us on the journey to financial freedom. And if you're ready to dive deeper into the principles that inspired Warren Buffett, watch our next video on Benjamin Graham, the father of value investing, the mentor who shaped Buffett's philosophy and changed the way the world invests.